There's a moment when investing stops feeling like something you do and starts feeling like something that's happening for you. Most people never reach that moment, not because they don't have enough money, because they don't understand that the game itself changes as you grow. The strategy that builds your first $10,000 is not the strategy that manages your first $1 million. The mindset that gets you to $100,000 will actually work against you at $10 million. Every stage of this has a different focus, a different set of risks, and a completely different version of success. Here's how it actually evolves, all 8 levels of it. You deposit money into an account, maybe $500, maybe $1,000. It's not the amount that matters, it's the decision. You've chosen to own something instead of just spend. That's the shift. And your first investment doesn't need to be perfect. It needs to exist. What you'll notice right away is that the market doesn't care when you arrived. Prices move without you. A stock you bought drops 3% the next morning. That discomfort is actually the first lesson, because the market was doing that before you got in, and it'll keep doing it after. Your job right now isn't to react, it's to understand. You start paying attention differently at this level, not to prices, to what companies actually do, how they make money, why people keep choosing them over and over. You begin to see the difference between someone watching a number blink on a screen and someone who actually understands what they own. That difference will compound just as much as your money will. The real mistake here isn't picking the wrong stock. It's treating uncertainty like an emergency. The investors who survive this level are the ones who learn to stay in the game long enough to understand it. The second shift has nothing to do with picking better investments. It's about building a structure that removes the decision every single month. You set up automatic contributions, $500, $1,000, whatever your budget actually allows, and you stop relying on motivation to do it. Motivation is unreliable. Systems aren't. This is where dollar cost averaging becomes your real edge. You're not trying to buy at the bottom. You're buying consistently through good months and bad ones. When the market drops 12%, you're still contributing. When it recovers, you benefit from every unit you bought at a lower price. Your portfolio starts taking shape, not randomly, but by allocation. A portion in broad index funds, a portion in ETFs, maybe a small position in individual companies you've actually researched. You're learning what diversification really means. Not just owning different tickers, but holding things that behave differently under pressure. The test comes when the market falls, and it will fall. The habit you've built is what keeps you from selling at exactly the wrong moment. Volatility isn't the danger here. Emotional selling is. There comes a moment in every growing startup where the founder realizes they've become the bottleneck. Every important decision flows through you. Approvals, strategy calls, creative direction, hiring choices, it all passes through one person. For a while, that's fine. You're the one who knows the vision best. You know exactly what the product should feel like, who the right customers are, what the company stands for. But as the team grows past 10, 15, 20 people, holding all of that yourself stops working. Decisions slow down, people wait on you, work stacks up. The company can only move as fast as you can personally process. Delegation becomes unavoidable, and for most founders, that's the hardest mental shift in the entire growth curve. Because delegation doesn't just mean passing off tasks. It means accepting that someone else will make a call differently than you would, and still being okay with the outcome. It means trusting people's judgment before they've fully proven it. It means letting go of the version of the company that exists entirely in your head and allowing it to become something built by more than one set of hands. You stop being a doer. You become a builder of doers, and the company slowly, awkwardly stops being you. Somewhere between $250,000 and $1 million, the question shifts. You stop asking, "How much can I make?" and start asking, "How much can I afford to lose?" Not out of fear, out of precision. At this scale, a 20% drawdown isn't just a number on a screen. It's $50,000 to $200,000 gone. And recovery from that takes time, sometimes years. So the way you evaluate investments changes. You're looking at downside exposure, not just upside potential. You're asking how an asset has behaved during market stress, not just during the bull runs. Tax loss harvesting becomes a real tool. You begin placing high turnover investments inside tax-advantaged accounts and holding your long-term positions in taxable accounts to reduce drag. The structure of how your money is held starts to matter as much as what it's actually held in. Your portfolio begins functioning like a system, not a collection of positions, but a coordinated set of allocations, each with a purpose: growth, stability, liquidity, hedge. You're not just investing anymore, you're designing. Cross $1 million in investable assets, and the financial system starts treating you differently. Not because you asked for it, because the rules actually change. Private markets open up, private equity funds, real estate syndications, early-stage venture deals. These aren't listed on any exchange. They come through networks, through advisors, through institutions that manage capital at this scale. The minimums are higher. The holding periods are longer, sometimes 5 to 10 years. Liquidity is limited, but the trade-off can be meaningful. These asset classes have historically offered return potential that public markets don't always match, along with lower correlation to daily market swings. You're being compensated for patience and for accepting illiquidity. Your evaluation process changes here too. You're no longer just reading price charts. You're reading deal structures, assessing the operator behind a real estate fund, evaluating an internal rate of return projection, working with private bankers and advisors, not to hand over decision-making, but to access the infrastructure they operate. The challenge at this level isn't finding investments. It's selecting the right ones from an increasing number of options that are suddenly in front of you. When your capital moves into the $10 to $50 million range, investing stops being something you do alongside your life. It becomes its own operation. A 5% return at this level isn't a rounding error on your spreadsheet. It's $500,000 to $2.5 million. Every allocation decision carries real weight. The cost of a mistake isn't just a percentage. It's a number large enough to matter for years. Your portfolio is now structured across multiple layers: public equities for liquid growth, private equity for long-term upside, real estate for income, fixed income as ballast. Each position has a defined role, and performance is measured against benchmarks, not emotionally, but analytically. Some investors at this level begin formalizing their structure, running capital through a family office or investment entity that handles reporting, tax optimization, and allocation decisions more efficiently. You start tracking internal rate of return on private investments alongside public benchmarks. The question isn't just how much you made, it's how efficiently you made it. The psychology shifts here too. You're no longer trying to win. You're trying not to lose ground. At this scale, preservation and growth have to be balanced, not traded off against each other. Above $100 million, the nature of investing changes structurally. You're no longer picking assets. You're directing capital. Decisions at this level aren't made in days. They're planned across quarters. A single allocation can represent tens of millions of dollars, which means you can't move quickly without affecting pricing or access. Liquidity becomes a strategic constraint, not just a feature of certain assets. You invest through managers as much as you invest directly. Hedge funds, private equity firms, infrastructure funds. Your job is evaluating the people and structures that deploy capital on your behalf. Due diligence goes deep. Fund structures, fee arrangements, track records, alignment of incentives. Your capital begins influencing outcomes. When you commit to a fund, others often follow. When you exit, markets notice. You're part of a network of institutional actors, and information, relationships, and deal flow move through that network in ways they don't at any other level. At this scale, you're not reacting to financial markets. You are one of the forces that shapes them. At $1 billion and beyond, the rules don't just change, they invert. Positions are no longer investments. They're ownership stakes in companies, in strategies, in entire market segments. When capital at this level moves, markets react. When it exits, it's news. Entering or leaving a position takes planning, timing, and coordination. You don't move fast. You move deliberately because moving fast has consequences. Private markets are the primary arena. Direct deals, co-investments, strategic equity stakes that aren't visible on any exchange and aren't available to the public at all. Opportunities don't need to be found. They are structured around you. The conversations change too. Counterparties are executives, fund managers, and other large allocators operating at the same scale. Decision-making happens through relationships that most investors never access. At this level, the question isn't how to grow capital, it's how to deploy it wisely. Because capital this large doesn't just participate in the economy, it steers parts of it. And that's the full arc. 8 levels. Not 8 account sizes, 8 completely different games, played with different tools, different psychology, and different stakes. The investor you are today is not the investor you need to become tomorrow. Every level demands a different version of the same discipline. The only question is which level you're working toward and whether you understand what that actually requires.